All right, let's move forward in terms of the detailed process, how we actually do this. In order to close accounts, what closing accounts means is that we want to zero out the balances. Okay, so the goal here is to make sure that the normal balance side for these temporary accounts has a 0 at the end. So to do this, this is really simple math. Let's say if there's $5,000 of revenue and you want the goal to be 0 at the end, then you just post something and journalize something on the opposite side. Okay, so we're trying to transfer revenue to later on in retained earnings, but by doing this, in the middle, we open up an income summary account. This is really an account that you will never see in any statements. It's just for the purpose of doing debit credit. We want to transfer to retained earnings. We have this temporary account in the middle of the process. Okay, later on, you will see this account just disappears when it gets to the very last step. So by doing this, we post in dollar amount revenue over here, and we transfer the $5,000 here. So this is the first step. We want to close revenue account to income summary. Income summary is just a new account opened up for the purpose of closing entries. You will not see this account anywhere else. You will only see this account open up in the process of closing entries. So just to help the debit credits when we transfer information to retained earnings, it stands in the middle. Okay, so this journal entry itself, you will see revenue be debited and then income summary be credited by whatever amount there is right now on the income statement. Okay, so after doing this, remember revenue's normal balance is the right side. So for the most part, you will definitely see a type of a certain value here on the right side of the revenues after a month of business activities, after a quarter of business activities. What you do here is just debit the exact amount you see here and transfer that amount to income summary. Exactly the same for the purpose of making this account 0. So that's the first step. In terms of closing expenses, let's assume that there were $2,000 in total, and let's just say for simplicity purposes there's only one expense. So if we were to make this account 0, we'll be posting something to the opposite side. Credit all the expenses, exactly the same amount. Transfer this to income summary, $2,000 here. So income summary, you can think of it as having the same balance, normal balance side as retained. Because we always put revenues on the right side, expenses on the left side, while we do this closing process. So the first entry will be debiting revenue and crediting income summary. Second entry, because expense has the opposite rule, so we'll be debiting income summary and crediting expenses. This is the second step. Again, the purpose is to 0 out balances. That's why we're doing this. Just copying the exact same information there to cancel out this account. So after this journal entry, this account balance goes back to 0. When it starts in 2013, January 1st, it will start from 0. If you earn revenue, let's say after a week $1,000, you only see $1,000 there for the next season. Okay, we're closing this out. Second entry, by doing debiting income summary and crediting expenses, we also 0 out expenses. So then you will start next season from a 0 balance. You will add in new information related to expenses that incurred for that period of time. Okay, so these 2 entries will 0 out those 2 accounts. Now we only have income summary, dividends left. Okay, so what we're doing in the third step there, close income summary, transfer the amount to retained earnings. What that means is really transferring net income. So by these $2 amount, it's pretty obvious that the company has net income here, that worth $3,000 net income. Now we want to immediately close out this account. So remember that this is just a temporary account that I opened up for the purpose of closing all this. So if we want to 0 this out, we'll do something to the opposite side, transfer this $3,000 to the right side of net income, the right side of retained earnings, because there's net income here. And this brings up retained earnings balance. Okay, so once again, once you transfer revenue and expenses to income summary account, the first question would be whether the company this season has net income. If there is net income, put net income here. Otherwise,
We'll have a net loss.
on the left side. So in this case, there's net income, and then you want to close out this account.
In order to make this part
Zero, you would be debiting income summary for the net income amount, and then crediting retained earnings for this $2,000. I'm sorry, $3,000. Okay, so then $3,000, now the whole purpose of doing all this
three steps.
is to transfer this net income to the right side of retained earnings. Okay, in accounting, this is how we do the closing steps. We open up an income summary account, do the debits and credits to zero out revenue and expenses. Then we immediately close out income summary account, transfer retained earnings to the credit side. To transfer net income to retained earnings credit side. So if it's the opposite case, in any case if there's net loss essentially reduces retained earnings, so you will have to debit this amount if it's net loss. But if it's net income, it brings up the accumulated earnings amount. So we'll be increasing this by crediting it. That will be the third step. One last step here, dividends. Dividends, we also consider this as temporary accounts. Remember, this is an account that only will be opened up if the company decides to declare dividends to shareholders. So it's not necessarily, you won't necessarily see this account every single season.
Let's say there is $500
dividends given away to shareholders in this season. We want to close this account as well. So next season, when you see dividends, it only relates to that season's reward to shareholders. So when you look at this account information, it's not an accumulated information, not an accumulated reward to shareholders. It only relates to that season. Okay, so we want to close this account again. The purpose is to zero this, so we credit this. So originally the balance is debit side. We credit this, and then we debit it to retained earnings. Okay, remember dividends is also eating up a part of retained earnings. It reduces retained earnings. In the statement of retained earnings, it has to be deducted. Okay, so then overall you have net income increasing retained earnings balance, dividends here decreasing retained earnings balance. So the fourth step really would be debiting retained earnings and crediting dividends. So if you look at this retained earnings account here, unless this is a new business, otherwise usually you will also have a beginning balance of retained earnings here. So let's just assume it's $6,000, assuming. So this retained earnings has accumulated earnings, let's say all throughout the past year, together there's $6,000 accumulated. Now this season we have additional $3,000 and we gave away that's reward to shareholders. So overall, this account now finally would represent the same balance as statement of retained earnings. That would be $9,000 minus $500. So you will see $8,500 as the ending balance. And this amount should be exactly the same as what you see under statement of retained earnings at the end, the balance, and also what you see on balance sheet. Okay, so in summary, what this process is trying to do is to match this retained earnings T account to the same balance as what's given away, as the financial statements, what's given away to shareholders and creditors, what they see on financial statements. So before this process, really retained earnings account, you will only have the beginning balance $6,000 there in the T accounts. Right? But in the worksheet, we see their beginning balance as well, but in statements, we're readily transferring net income information to the second statement. So we just want to match up that amount with the journal entries and also the accounts, specifically for retained earnings. Okay, so this is the only step where retained earnings balance will be updated. Before this, we don't know what was the total net income or total net loss. So all this information is only summarized in the first financial statements. So later on, we just go back to match up retained earnings to its current balance. So next season, we will start from $8,500 instead of the original beginning balance. which haven't considered this season's net income or dividends.
By doing this,
Income summary is just an account temporarily holding all these information for the purpose of closing out revenue, closing out expenses, and closing out dividends. At the end, everything falls into retained earnings account. And this disappears, this being zeroed out, this is being zeroed out, this is also being zeroed out. Everything goes into retained earnings.